Good morning, everyone, and welcome to the European crossover webinar, and welcome to FOMC Day. Give me a moment, just restarting the MacBook. Okay, we did see the euro, not the euro, I meant to go and say the dollar yen, going to do a little bit of a slide yesterday, and it's actually quickly moving into slide mode, so to speak. And quick lost those gains, but recovered back. And we did have a weak Japanese data yesterday. And let me see if I can go back to that. Hang on. Posted that in the room, and man, that really got the yen going. See if I can go back to that. But we got the yen moving up, and actually we posted, excuse me. Gonna go make sure we go and find that. Here we go. Let's see. Yeah, it was a Tankan survey. The Tankan survey. Actually, we can see if we can just move into that. And that might make it a little bit easier. So hang on. I usually don't switch screens anymore, but let's see if we can go that route. So you can see here the Japan Manufacturers Index plus 10 in March versus plus 13, matching the lowest seen since October 2016. So, excuse me, that really got things going. Actually, I mean, it was a delay. Then we started to move up a little bit higher after that. But you can see here that it was in pretty bad shape at that time. And we really got the dollar yen clipping along here. Let's go and move back into the other screen. So getting back into the yen, we actually had posted some analysis on the website for the Asian analysis in preparation for Fed Day. So this is the dollar yen has continued to lose momentum despite equity upside. Well, obviously we're starting to pare back a little bit in the equities. And an expected pullback in equities over the next 7 to 10 days should result in a sustained move to 1045. Resistance is 1074. And I meant to say, I don't know why I put this here. I meant to say 1174. A daily close above 1187 would negate the trade. So let's go and take a look where we are here in the dollar yen. So this is what we're talking about right here. Resistance is 1174. We're actually looking for a move here. We've talked about that before. Down here to 1034. There's that area 1034 with an eventual move that we believe is going to go back down to the pivot, which is 927. So not too much risk on this trade. What we're looking for is this resistance. We almost made it there last night. I was actually working on an offer at 72 at the time, and the S&P started sliding that a little bit, sliding under 2025 or 2825, and that kind of lost a little bit here because it looked like we were just marching on and we were going to clip up here, which is this area right there's 1174 of this little move. And I usually don't go with moves unless I'm scalping, but this would be 78% of this move. But it's really here. It comes across here. I like this 1174 as an area for entry. We might see that on FOMC. And then I think that we'll go and get a move going lower. My thoughts being is that some people were asking, hey, do you think that the Fed's they might even surprise and cut rates? Well, that's not the way the Fed works. They're not going to flip on a dime. There's no reason to do that. But I think Powell's going to go in and say, hey, look, the economy still looks pretty good overall. I think that'll give that dollar a little bit of extra bid. But then the whole idea about, exercising patience, the balance sheet, then eventually I think that the dollar will start to slide at that point. But initially on his comments, I think he's going to go on and say, well, the economy is still in pretty good shape. We're still seeing growth. We're still seeing job growth, blah, blah. And then that'll give the dollar initial boost on the first few minutes. And that may allow this dollar yen to come up here and hit this 11.74 area. Now, like I said, the only thing that takes this this trade out of the box is, let's move into here. Is a daily close above 1187. We get that daily close above 1187 and we're going to start pushing the momentum higher. So looking to short, coming into anywhere that 1174, a daily close above 1187 negates the trade. Target initially is what we're looking for is 1034 with a some support coming in right there. Initial, like a short-term target. Here's the 1095. We had that before in the market, held the market here, but that'd be on a short-term basis. We're looking for 1034 here. Overall, I think eventually, if we do see that good equity slide or pair back, it'll get down to 927. And speaking of which, let's just go and take a look at that before we get into the news. Here's my take on this whole thing. We've really, knocked some people out of the box since Friday. But the reason I'm thinking that we'll go in and see a pair back, and we talked about this 28.25, very key area. I was surprised to see it get above it, but obviously, like I said, on Friday, they're really pushing above it. And then obviously added on to Monday. And then yesterday, we even squeezed some people and I think knocked some people out of the box at that point. Look, a bull market, and this certainly has been a pretty good bull run here, needs buyers to feed on it. And with however that buying comes about, and obviously I think a lot of it yesterday came about with shorts being, basically run over to a certain extent. I just don't see at this point who's going to come in and buy at this level. I'm not saying it's they're going to buy on dips, but at this level, I just don't see it. So the last hurrah that you had was shorts being squeezed, and I think you saw that from Monday and Tuesday. I just don't see is there any more real juice, and people are already expecting. Part of the reason that we're up this high is because people are already expecting the Fed to lighten up anyways. So I'd be shocked if we took out these highs. If we took out these highs on the FOMC announcement, I think that I could be wrong, but my thought would be you're going to see everybody and his brother, mother, sister, and uncle, and even the dog catcher trying to have offers into this area. So if we do get a rally off this FOMC, it may just be slight. I'd be shocked, honestly, if we were able to take out these highs here. So my guess is there'll be all kinds of offers in here. We pop up there and probably start to go in and fade back. And henceforth is what I think initially on the dollar bit, you'll probably see the dollar go a little bit on his initial comments. And one of the reasons that we did start to slide yesterday, we lost 5 quick candles from 28.40. What was it? I think it was 28.48 to around 28.43. Quickly was that some U.S. officials said, "Hey, look, things aren't going so well with the China news." And then someone in the chat room was saying, "Hey, look, look how quickly it came back." Well, the proof is in the pudding, and yeah, they come back a little bit. But look, as the day went on and we went into Asia, this thing started sliding like nobody's business. And I think that news, this whole China talk news is about as old as Methuselah. So, my point being is that, this has been a pretty good run here for those saying, hey, I'm waiting for that good China talk news. I'm waiting for that good China news. And then shorts, one thing fed on another. Shorts started getting squeezed. But at this point, I think if anybody's saying, wow, I think I'm going to get long here for that great announcement of the China news, I think they're crazy as they used to say, as a rat in a shit house. So I just don't see that crazy than a rat in a shit house. I just don't see that happening. I just don't. That story is come and gone, and it's fed on here with shorts being run over, then the whole idea of a softer Fed. Honestly, like I said, that's my whole idea, trying to tie it into why I think that the dollar yen, I think, will eventually go on and slide back. Another thing we'll see in the news is it was saying, hey, the dollar's up on these trade war jitters. Look, I think that story is about as old as Methuselah too, because one of the things we talked about and why the euro was starting to come back is because the narrative, and I couldn't think of the right word a couple of days ago, the narrative is starting to change here on the euro, and we talked about that. The glass going from half empty to half full. Well, you know what? The PMIs, they're not so bad. I mean, they could have been a lot worse, and they're actually proven. And then they've made even the comparisons to the U.S. Well, the U.S. is actually surprising to the low downside, and the euro is surprising to the upside. And those economic reports, meaning the economic reports are still pretty crappy, but they're not as crappy as they could have been. My point being is the narrative's starting to change. So this whole China war trade jitters about the dollar being the cleanest shirt in the dirty clothes hamper, I think is going to lose its steam. If we get this whole thing about China and maybe they're backing away or whatever the case, you'll probably see a little bit of a dollar bid. But that whole narrative is the dollar's going to outperform, I think, is starting to lose its momentum there also. And also, if we think we get past this whole Brexit business, this cable is going to take off like a banshee. And like I said, the narrative is already starting to change here on the euro. Matter of fact, I think the year going back here to the before we get into the news, we'll get into the last of the analysis and just giving you my 2 cents on this. Let's go and move into the euro. So it says a slow, wrong one here. Get into that Asia update. Euro closed above the elusive 1340 level with exponential moving averages closing in on a buy mode. Euro longs can now be initiated to dips to 1316. I'm talking about the dips with FOMC, because I think that, like I said, initially Powell would probably say, hey, look, or the comments will come out, hey, you know what, the economy's doing pretty good, things are still looking good, boop, you get a bit in the dollar, but I think eventually they'll go on and sell into that. So that's what I'm saying. I like dips going into this 1316, which was actually, I believe it was 1316. 1316 was our support from 2 days ago. We actually moved up yesterday to 1320. Upside target is 1445. A daily close below 1291 would invalidate. So once again, pretty good risk reward if you think about this, because what we're looking at on here, we're saying dips to 1316. I want to go on and buy those, okay? And the trade's only invalidated if we get a daily close below 1291. And we did, as I mentioned here, you know how we've been knocking it up right here against this 1340, and we were talking about how important that was. We've been talking about that since, early last week. Well, they tried to make runs to it, couldn't take it. Finally, they took it above it. They couldn't close above it. We went back above it, still couldn't close above it. But we finally did. So things are starting to change, and the exponential moving averages are now starting to flip. They're very close to flipping to a buy mode. But we have closed above 1340, so we're going to give this the bullish, scenario. Give it that benefit of the doubt. We're looking for to buy, and moves down here to 1316, could be 1321, 1316-ish, and the move only gets invalidated from this move up to what I believe is going to be 1445. Now, we said before, hey, if this market could get above 1340 last week, we're saying, hey, look, the target is going to be 1413, and that will be on a short-term basis. But I think if we can get past Fed Day, this is going to be your first target, real target. 1445. You probably see a little bit of a pause at 1413, but this is where your real target would come in place. So once again, daily close above 1340, which we've already got. Exponential moving averages look pretty good. FOMC, we're looking to buy on moves down to 1316. Trade is only invalidated if we get a daily close below 1291. So enough on that. Let's go on and move into the news. So on the morning bid, May bites the bullet on extension letter. British Prime Minister Theresa May is widely expected to write to the European Union today requesting a short extension of Article 50 process on leaving the bloc. The 27 EU capitals who must decide on whether to grant such a request want detailed explanations of what she will do with the extra time before most likely granting it to her. Questions remain exactly how long such an extension will be and whether it will be an option for a longer one. For now, it's not even clear the EU leaders will be ready to grant it it at this week's summit. They may wait until next week to see whether she really does have a plan to break the impasse at home. Overall, while it's increasingly hard to see Britain crashing out of, on March 29th, the two most diametrically opposed outcomes, a no-deal exit at a later date and a no Brexit at all, remain in play. Let me take a look. I'm not really interested in any of this politics stuff here. Let's go and move on to the markets. World markets have largely frozen ahead of the Fed policy decision later and amid the Brexit impasse. Although the outperformance of European stocks on Tuesday was a standout after the latest global investor survey from Bank of America showed short Euro stocks positions replacing emerging markets as the most crowded trade this month. Helped by a rally in auto sector amid merger talks surrounding Fiat Chrysler and Peugeot, Eurozone stocks gained almost 1% to hit their highest in September, with a dovish Fed message now largely priced into the world markets. The recent equity market surge elsewhere stalled before tonight's decision. Hence, that's exactly what I'm talking about, folks, is why I believe the S&Ps will go and start to slide. Look, this whole this whole idea about the Fed being soft and coming in, which I think will be the case as far as soft as far as patience, has pretty much already all been priced in. So as I said, the S&Ps have already rallied. I think they ran over quite a few people, not everybody, but they did ran over quite a few people. So what's going to take us to that next stage? At this level, it's not like as if we're trading at 27.75 or 28 even. We're trading here, still not that far away from the 28.50. Who's going to buy at this area when you had all the shorts going? A lot of shorts, not everybody. A lot of shorts cave in. Do you really think they're going to hang on for that China news? Oh, it's around the corner. It's around the corner. It's around the corner. I mean, they've been singing around the corner since Moses crossed the desert. So that's what I'm saying. Who's going to hang on for that? And that's why I think that we'll start to see the S&Ps start to slide back once we get past the FOMC. I don't think it's going to be an immediate slip. I just think that it'll start to gradually pare back. Sterling slipped lower against the dollar amid reports UK PMA will now seek only a short delay in the Brexit deadline from European Union leaders at Thursday's summit, knocking back some speculation on a delay of a year or more and the possibility of a second referendum, or even if Brexit Commissioner Chief Juncker said had yet to arrive in Brussels. The panel was also eyeing this week's Bank of England meeting for signals about what happens to UK interest rates if Brexit goes ahead with some sort of a deal. Future markets show the BOE is now the only G7 central bank still even partly priced for an interest rate rise later this year. Strong UK jobs report on Tuesday underlined that although inflation numbers due out later today are expected to be soft. Well, like I said, when I was comparing, when I was talking about the euro, remember earlier this week, I said, hey, look, one thing about the cable, or if you're looking at sterling, hey, they're the real deal. They actually do have some good economic reports to actually say, hey, look, if we get this thing straightened out, the pound could really, start to take off, to the upside. Well, once again, like I said, and the euro has not. But once again, like I said, the narrative is starting to change. Now everybody's saying, you know what? These reports, it could be a whole lot worse. And when you compare them to the U.S., yeah, the U.S. is performing better, but they're surprising on the weaker side compared to the euro. That's surprising to the upper side in these economic announcements. My point being, the narrative is starting to change. So this whole China business, oh my goodness, let's the sky is falling if China didn't come with a deal, and why you're going to buy the dollar because it's going to survive better overall. That's starting to lose its steam, folks. That's what I'm saying. That the least dirty shirt out of the hamper is starting to lose its steam, and why I think that although initially on those trade jitters you'll see a little bit of a dollar bid, I think that will start to fade as the narrative on European reports, economic reports, are starting to go on and change. And if Brexit comes out, then you really get some push pressure against the dollar. Anyway, moving on, emerging market currencies formed ahead of the Fed's decision. Meantime, with Russia's ruble continuing to strengthen, on the European corporate front, well, we already know about all that stuff. So we had German producer price indexes, and let's move into that quickly. So the surprising here was it did come out a bit lower here in Germany, and that's come in a little bit to the downside. But other areas such as France and even Italy truly actually has surprised. I thought that thing would really be under some pressure. And over the last, 2 or 3 weeks, they've surprised, where you could make the legitimate case that Italy would really be under pressure, and their surprises, not being as bad, have looked a lot better. And France had some decent numbers. I think, what was it, about 2 weeks ago? They could have been in contractionary mode. They actually came out of that contractionary mode. And so, once again, things are starting to change. We do have UK inflation at the bottom of the hour. You see PPI outlook. And moving on, nothing as we come into the States. So it's probably going to be fairly quiet. EIA oil stocks, of course, but then we get Fed decision at 1 p.m. Eastern, or actually what you call it, 2 p.m. Eastern time. 1 p.m. Central for those of us here in Texas. So let's move this out of the way. Australian New Zealand dollars dragged down as bond yields hit new depths. The Australian New Zealand dollar slipped on Wednesday as bond yields extended their breakneck decline to multi-year lows amid speculation interest rates in both countries would have to be cut in the coming months. The drops in yields even overshadowed the expectations the U.S. Federal Reserve would sound dovish at this policy meeting on Wednesday. Bonds have rallied hard in the last couple of weeks in soft economic data globally and strong investor demand. The RBA Assistant Governor Michelle Bullock on Wednesday argued the risks from housing were contained for now, though she urged banks not to tighten their lending standards so as much to depress prices even further. The central bank is still counting on the labor market to stay resilient and its wages and growth over time, heightening attention to the February employment report due on Thursday. Median forecast for a moderate 14,500 rise and a steady unemployment at 5%. The risk, however, is employment is below expectation because of the sharp slowdown in the economy in the second half of 2018, said Joseph Carpuso, senior strategist at CBA. Any sign of a rise in the unemployment will have the RBA on high alert and will weigh on the odd. The Kiwi faces its own data hurdle from GDP on Thursday, where any downside surprise would further compress bond yields. So that's something to keep in mind. Keep this story right there close by and maybe tag these numbers of what the market's looking for. Moving on, the dollar gains on trade war jitters before the Fed. Dollar rose on Wednesday, attracting safe haven bids after reports of further tension in the U.S.-China trade negotiations, but his gains were slight and with caution expected. And folks, that's exactly what I'm talking about. Look, it's the old thing when the doctor comes over and he taps your knee and your leg pops up. Well, it's the same thing right now. Trade war jitters with China. Oh my goodness, let's buy the dollar. But look, it's starting to lose its steam. Remember, we would see times when, I remember this was like in months ago, you hear those China war things coming about and you see the dollar index rally. Literally, I'm not joking. I remember some times rallying 50 ticks. Now you just get a little slight pause over it. And my point is being, that's is actually, to me, I think, is a microcosm of what I think is going to play out overall. So if they do get that, you get that initial run, but I think over the next few weeks, you're going to see the dollar start to lose a little bit more of its bid. And why I think it's not really so much the dollar play and I think the euro will move higher, but it's this whole equity run. I think that's losing its steam big time as far as we can see further advances. That's my point, because we've already come so far, and I think you've climbed on the backs of a lot of shorts, and that's fine and dandy. But who the heck's going to be buying the S&Ps up in here? Because you'll have to have some real buyers now. It won't be short covering. The Aussie dollar, a proxy for China's risk before Australians' dependence on Chinese demand for its exports, slipped 0.25% to 70.70. Against a basket of key currencies, the dollar index was 0.1% higher at 96.45 after hitting its lowest level since March 1st at 96.29 in overnight trading. If you remember, we had our support was 96.26. Some analysts said the dollar might not decline significantly on the Fed meeting since investors already priced in the central bank scaling back its interest rate outlook. The markets look to be very much positioned, expecting a benign FOMC outcome, confirming a continued pause. Well, more signs were evident in Germany in a survey by Zoo Research Institute, indicating mood among German investors would prove more than expected in March as potential delay to Brexit from European Union help lift sentiment. Lastly, we'll take a look at the Fed, what they're looking at. They expect to hold rates on steady. The U.S. Central Bank, since early this year, has signaled a patient approach to increase borrowing. Investors now put a 75% probability on the Fed won't raise rates in its overnight benchmark. New quarterly economic and rate projections to be released with the latest Fed policy statement at 1 Well, for me, it's 1 o'clock. It was 2 p.m. Eastern. Fed's December projection called for 2 hikes this year, but it's widely expected to cut to a single increase at the conclusion. It would take a downward move by 7 policymakers to bring the median expected number of hikes to 0 for the year. More intense focus among investors may be on the balance sheet, as the Fed plans to stop reducing its holdings of Treasury bonds. Details of that plan are also expected to increase on Wednesday, providing investors with a sense of how much longer the drawdown will continue and will be left in the Fed's portfolio of assets when it stops. Meetings of the Fed policy meeting in late January showed officials wanted to announce before too long a plan to stop reducing asset holdings later this year. Fed Jerome Powell is due to hold a news press conference half an hour after the release of the policy statement. Fed officials are generally pointing to the rundown ending sooner than later, with perhaps just a few more months to go before the central bank hits a level where it's comfortable stopping. Assuming the shrinking process stops in October, the balance sheet should end up in a 3.75 trillion region. That's more than triple the size of the Fed holdings before it began 3 rounds of quantitative easing, in which it purchased trillions of dollars of treasuries and mortgage-backed securities in response to 2009 crisis and recession. Having built up its balance sheet, the crisis and its aftermath, the Fed began to normalize its holdings in October of 2017 with a steady reduction of up to $50 billion per month. Having studied the section of financial markets to reductions as well as the use of reserves held by financial institutions at the Fed, the central bank concluded the most effective way of managing interest rates moving forward was to keep the supply of reserves ample and pay interest on any excess. So we'll see how that plays out. Now let's move into the analysis. We had a somewhat sort of analysis as far as looking over of what the Asian analysis was, and like I said, a couple of trades I was looking at, the euro and the yen, and we basically have it right there now. So when we're looking at the euro, I've got 1320. That's a good area of support. The trade I'm looking at is a move all the way down to 1316 to look for a move. We did close. Look, we closed above that 1340. I'm keeping this here because if we were to close below 1340, that doesn't look so good. I mean, let's say we were to dip down to 1316, we bought them, and they move higher, but we lose that close below 1340. That would not look good. That would not look good here on the daily after doing that. So that would be an area of concern. Obviously, if you picked them up at 13, 16, 17, 18, 19, 20, 22, and they close up at 1335, well, we're up, but that would be a concern to slide back below 1340. I myself wouldn't even hold it at that point. I would just get the heck out of Dodge and let's see if this market can give some momentum. On the upside for resistance, let's go and move into the 2-hour chart. Resistance on a short-term basis. Overall, we're looking at this 1406, and if the dollar starts to lose some steam, but initially on the first blush, it'd be 1387. We've got already that mark, and we'll give it the benefit of the doubt because it closed above 1340. Move now to bullish mode. Well, for now, cable's stuck in neutral until we get past some of this foolishness. Nothing's changed. 3374 is key. We have 3178. There's 3178 here. Because it's weakening just a bit, we'll give a little bit of room here. So it's going to come in right there at 3147. And I want to move it. Normally I would just say, no, forget it. We're going to keep it 31.78. Looks like some UK data just hit the screens right here. There we go. PPI came in at 0.6. They were looking for 0.9. UK inflation gives households a break from Brexit jitters on the inflation. Came in right with the Reuters poll at 0.5. That's what I'm saying. The case in the UK, that's a real deal. That's really some news that's turning around, unlike the Eurozone. But once again, like I said, the narrative is changing, where it's now the glass is half full despite the weak economic news, still coming out. We saw the German data come out. On the upside, resistance comes in right there. 33.33. Let's go move into the odd. Well, we had 71.30. Nothing's changed. Low side 70.68. We did get down to 70.58. And we'll just have this level right there, 70.52. Moving into the dollar CAD. This thing really recovered well. Previously, I remember we had an area here, and I kind of ticked it myself. I saw, actually, when I saw it, it already started to come back up a little bit. I think it may have already been in the 60s or something like that. But I thought about right here, that 32.50-ish area here. But boy, did we come back. Look at this hammer. This thing came back with a vengeance. It really did. I was actually working a limit on the way up, and it missed me by, I think it was 2 ticks. What do you want to say, 2 pips? I pulled that after I missed that. I wasn't going to hang around again, but it was on this move back up here. And I was working 21, and it missed me. Yeah, there was. I had 21.5, and then we turned around, we slid back. Not a whole lot. We slid back to 107, so it wasn't big, that much. But now we've come back and reasserted ourselves, and man, it's got to be disappointing for those CAD bulls that came up. But the only thing that I don't understand is, and I wanted to see some momentum, but it came back with a vengeance, is because as long as crude was up here, I don't know why you'd be buying the CAD when crude was still above here at 59. Remember? Now we did get back below that 58.96 again. That's been that key area. But honestly, you knew it was susceptible. The dollar CAD was holding up very well despite crude being higher, but you still had that risk. And then they broke them yesterday. But of course it came back, and it came back with a vengeance. I got a little bit too greedy. I was thinking, okay, I'll work a limit at 32.38. But at the time, crude was still trading on either side of $59, and I just don't see why. I mean, you knew it was susceptible, but it was just holding still despite crude. But it was very susceptible to move along. I think our bias chart support was 32.98, and then here's our area here before the 38,271. I guess this area ended up holding, although it cleaned some people out and then came back with an absolute vengeance. Resistance on short-term base be 46. Oh, yeah, look, that's what we went to, 46. Go in here, you see with these touches. See right there? Right there. For right now, that had to be a tough one to swallow. Seriously. We had this level before. This is where, remember we had that run up and right there, you see that? 33.66. That even stopped us at the pip here. I didn't get that, but right there at 33.66. We'll go with 33.66, but man, that's got to be some tough stuff for those that were bullish. Yeah, there was our 33.66. That's still in place. We said we needed a daily close above 33.54 to generate upside momentum, and that's been the thing here. That's been the fly in the ointment with the dollar CAD, because we have not been able to get this move. Look at this. It's like, remember, it's like we talked about this with the euro, the elusive 33.40. So until you could get above 33.54, you couldn't get that upside momentum. You see, so it was susceptible to lower. How much lower? Well, I probably would have thought this probably would have run out of gas in the 80s or whatever, but it didn't. It took it all the way down into the 50s. But boy, what a hammer bottom. Now, for those that are really long, this is for those that stayed long, this is very encouraging to see this thing come back. But once again, we'll see if the dollar kind of weakens. That might have a little bit of trouble. But once again, like I said, if we can get crude to start to pair back, then once again, it'll probably be like 3 steps forward, 2 steps back, but it would still be able to advance. So we need that daily close above 33.54 to get that upside momentum. Short-term resistance is 33.66. Support, well, it's going to be the 33.14. Our old friend, we'll just move it just a hair lower to right there. 33.10. I think we even had that a couple of days back when it was still holding up. So it'll be 33.10, short-term basis. Let's go on the dollar peso. Man, this one has been something else. Props to Greg and Steve on this. But we are really overdone, and I like this area here, this 1973 right there. I thought it was going to dip and touch that yesterday. It didn't, so we're kind of holding here. If we do make a move, I think there'll be a pause here at 11, but I think you won't see any real significance until we come back up here to 15. So on a short-term basis, very short-term, we're going to go with 19 right here. But you could see some good short covering coming here. Short-term basis, actually going to go right there. 1907.2, 1907.3. And support 1897.3. Well, we're starting to get just a little bit quiet here in the crude. Excuse me. And What's been key, and we had this as 59.33 put here, but to me what's been key is daily close, 58.96. So we'll see what happens here, but let's take a look at a 2-hour chart for resistance. If it looks like this thing might be finally starting to get a little tired, resistance is going to come in right there. Leaving drawn out. We do have data, so that can certainly move it. Well, actually, we already had the data, so hang on. Data this morning at 9:30. There we go. So resistance is going to come in right there. 59.14. We'll call 59.15. Support is going to come in right there at 58.23. Oh, there it is. We already had it. Okay, on to the dollar yen. We already talked about that, 11.74. Dollar yen has continued to lose momentum despite the equity upside. An expected pullback in equities over the next 7 to 10 days should result in a sustained move to, and I put 10.45, but maybe look on the 2-hour chart. What we're looking for actually is 10.34 on the daily. Resistance is 11, meant to put here, we talked about that, 11.74. A daily close above 11.87 negates the trade. So we're going to go right there, 11.74. And support, $11.19. Now on the trade we were talking about, we're looking for 10.34 minor 10.95, but we're just talking about here within today's range. Okay, moving on to the ASEAN. Resistance is going to be right there at 79.29. Support, we'll keep that 78.62 for now. But that thing could give way if we see the equity start to slide later on today. So just keep that in mind. That'd just be initial support. Actually, I'll move it a little bit lower. Let's go and move it just to be on the safe side. 78.49. I want to give it a little bit more room. Dollar index. Well, we did see that upside boost. I mean, we really hung around here. Here's our support, which was 96.26. See, from there, 96.26 was our support. Now, we're still thinking we're going to make a move. That was our Asian analysis to start the week, 96.05. But our support was 96.26. The low was what, 96.29. Upside, because I think Powell's going to go and say, oh, well, the economy overall is doing pretty good, blah, blah, blah. So I think we can see a little boost here. I'm not interested in any of this Chinese news jitter stuff. That story is, if anything's older than the Brexit, even though the Brexit is technically older, is that China, U.S.-China talks, that thing is about ready to talk about nausea. I'm sick of hearing about that thing. That thing is losing its steam. So you might get the, as I said, the doctor hits your knee with the little instrument and your knee pops up. Well, you're going to get that a little bit on this dollar when they mention China's stuff, but each one is fading more and more and more. Once again, like I said, I can go to moves back in August and September, and we see 50, 65 pip tick moves in the dollar index, just to mention the China news. And now all we did was we picked ourselves up off the basement just a little bit, basically just lifted its head, and that's about as good as it gets. So upside, we'll give it right there, 96.74. Right there. This can be upside resistance. Really, anywhere between that 62 and 74. May even have a hard time even getting to 74, but we'll see. Support, that'll be this 96.08 and 5 right here. Because if we do start to slide, I think, well, we'll go with 96.05 because we'll probably take that dip and then before we pop up. So I'm giving it a little bit of extra room. Let's go and move into gold. Gold is playing it relatively cautious. Here's that 50% we've been looking for since the prior week. We did finally make a couple of stabs towards it, but if we get the dollar slide, we can make a move up to this 13.23. Initial resistance, so would come in probably at 13.18 if we see the dollar start to slide here. Yeah, 13.18. I think they would make a run to that, and then before you see the market kind of back off a little bit. That'd be like an upside target. For anybody paying for the long side support, we'll still go with this 12.93. Let's go and move into the bunds. Well, we finally broke a little bit lower here. And once again, the news is getting a little bit better. Made a run right down to technical level to 65.78. Support's going to come in right there, 65.89. There's resistance, 66.39. Right there. Wow, we did make a pretty good move. Remember, we kept our 11.729 just because we said we're going to stay with the technicals, but look, we did make a good run. Holy smokes. And they said that was one of the most crowded trades also. So here's my take here. It goes back to what I said about the S&Ps. It was the most crowded trade, so that's why being short these European stocks. So, you know, you climb and you climbed on the backs of the shorts, okay? My point being is, although things are, like I said, the narrative is starting to change a little bit for Europe and saying, hey, things are getting a little bit better. They're not as bad as it could have been. And so the downside I don't want to say it'd be limited in the true sense, but I'm saying is you'll probably find some more bids as we go lower, as opposed to what I'm thinking is the S&Ps, because like I said, once again, who's going to buy here? I mean, people are still hanging on and hanging on and hanging on for this China news. Well, we've already made a fabulous run, and then on top of that, you had the thing about the Fed, and that's already been bidden. Then you rallied on the backs of the shorts. I mean, it's like, wow, I think that China news, it's just right around the corner. These China talks, I guess I'll buy it here at 28.35. Are you crazy? That's what I'm saying. So that's what I think it will probably see once we get past the Fed, we'll probably see a sustained move lower. I'm saying the bottom's going to fall out, but we'll probably start seeing this thing weaken. So moving on to the DAX, resistance is going to come in actually right there, 11.730. Well, there you go, 11.729. Let's stay with that. And support is going to come in right there. We're going to actually looking for a little bit move lower, 11.586. Well, here's the bias chart, and essentially I've given you my 2 cents as far as how I think things are playing out overall when we talk about the S&Ps, and how that could play into the dollar, play into obviously gold, because obviously then if we do start to see a slide, we'll probably find a little bit bid in the gold market, and then we do see a slide, we'll probably see the interest rates move a little bit lower, which would then allow the dollar yen to go and work lower. And as I mentioned here is moving back over here, I think that equity slide will also aid and abet for the dollar yen to move lower. And once again, here on the euro, things are starting to change there. Probably see the dollar start to slide. You'll probably see initial bid with the dollar as Powell gives some positive remarks about the economy, but I think that we'll eventually see the dollar come back. And any knee-jerk reaction, quote-unquote knee-jerk reaction on this China news is to be faded in the dollar, in my opinion. Anyway, that's my 2 cents ahead of the FOMC. And thanks for joining us here on the European crossover. I'll get this posted into the room.